markets function better when you know what the bazooka is going to do. I don't want to really use the word loose cannon because that's not exactly what he is, but there needs to be a plan of how he's going to use the bazooka.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. We still live in an era where the markets hang on every word uttered by the Federal Reserve and its chairman, Jerome Powell. Last week saw the Fed raise the federal funds rate by 0.25%, which was expected, but then Jerome Powell spoke and the markets immediately started spiking higher, which was very likely not what he was hoping for. For several quarters now, the Fed has been locked in a game of chicken with the markets, who expect the Fed to reverse policy substantially sooner than Jerome Powell is trying to guide the public. Who's likely to be proven right, the markets or the Fed? For perspective, we welcome back one of the best Fed watchers we know, Axel Merk, President and Chief Investment Officer of Merk Investments. Axel, thanks so much for joining us today.
Great to be with you again, Adam.
All right, well, Axel, look, the timing here couldn't be better because we had the Fed meeting last week, but also Jerome Powell was just interviewed by Carlyle Group founder David Rubenstein at the Economic Club of Washington, D.C., and we now know the aftermath of that. So I want to dig into all that with you. Very quickly, though, just to set the table before we get deep into the Fed, I want to ask my normal kickoff question. What's your current assessment of the global economy and financial markets?
The future looks great, hasn't been better, nothing to worry about.
I detect maybe a hint of sarcasm in that.
No, you got to keep motivating yourself. I just looked into taking some sort of first aid course in case. One of the things I learned during the floodings we had earlier this month is people have absolutely no clue how to take care of their home. So what if there's a real crisis, not just this monetary stuff? Well, what do I think, right? We have a mess out there, but we do also have policymakers that are excellent at kicking the can down the road. And so what I do know is that you'll have a job because we'll have something to worry about for an extended period. So that's my quick summary. I'll leave it at that.
All right. Okay. Well, we'll dig into the specific reasons why, but again, let's go here for the Fed. All right. So we had last week's Fed announcement, and then the Powell presser after that, and then the market's reaction to that. Why don't we just start with, what were your key takeaways from that? I know what I heard from Powell, and maybe let me list them out, and then you can react to it in any way you like. The markets clearly heard what they wanted to hear there, or something that really made them, a lot more exuberant. But I heard Powell say, look, folks, taming inflation is still my priority number 1, 2, and 3, right? Like that hasn't changed, and I'm not changing course here. There's going to be more rate hikes. I'm going to do whatever I think it takes to tame it. And the plan is still multiple rate hikes from here, and then a pause that's likely going to last through the rest of the year. He mentioned disinflation about 15 times in that discussion, which is supportive of his, I'm going to do everything I can to bring inflation down. And hey, we're beginning to already see, that my campaign to destroy demand is beginning to work. But probably more importantly, he I thought took pains to talk about the delayed impact that he expects from the 450 basis points that have already been done. Right. So, I heard him say like, hey, I talked earlier that this was going to cause some pain in getting inflation under control. And in terms of the pain that we're going to see, you ain't seen nothing yet, folks, because the demand destruction from everything I've already done to date is just beginning to manifest now. So anyways, he also, and this was one of the things that maybe the market's keyed off of, he said he's not super worried about financial conditions at any particular given time. And I don't know, maybe that was the trigger word for the markets here. But to me, he just said, like, I don't really care what financial conditions, loose, tight, whatever. I'm just getting inflation under control here. So why, I guess, did you take away anything else from all of that? And why do you think the markets became so sanguine after that?
Well, you almost sound like you got everything under control.
I don't know about that.
So let's maybe take a step back, right? The reason we listen to the Fed is because the Fed controls a big bazooka. So that's why we care. Now, I think we all agree on that. The second portion, though, already, with you iterating all this, and that's why I cynically put in there that you think that Powell has this under control. All of what you're saying somehow suggests that Powell has a good framework. He's not going to do this until inflation is under control and this and that. And I think that is where I have the biggest issue. And I'll talk about the rest of what you say in a moment. But Powell does not have a framework that's decent, no matter how you look at it. When a higher for longer is not a framework, it's not a strategy. He can, of course, hike rates, and he can wait for inflation to maybe come down. But there is no coherent framework. Larry Summers said, in order to get out of high inflation, you need a new framework. You need a strategy. And what it means is really Powell should go. Once you have high inflation, it becomes volatile. It becomes jumpy. And by all means, the year-over-year comparisons are getting better. And so odds are that for the coming months, the inflation readings are going to be okay. No guarantee of that, but that's all right. But then what, right? What is he going to do? And so I just put that out there, that creates an inherent instability. So that's number two. Number three is...
Can I just repeat that in a different way for you to say whether I'm thinking of this right or not? But it sounds like you're saying, rather than having a plan for where it's taking things, the Fed is just in reaction mode.
They are tactical rather than strategic, might be a nice way of phrasing it. Reaction mode is also still very polite. It's more than that, though, because markets function better when you know what the bazooka is going to do. I don't want to really use the word loose cannon because that's not exactly what he is. But there needs to be a plan of how he's going to use the bazooka.
So maybe like an aimless cannon,
something like that. Yeah. So let's take the second of these bullets, if you wish. What you see is what you get. And so now I don't like what the Fed is doing. Well, who cares, right? What matters is what the Fed does. So what the Fed has said is going to do is they're going to be higher for longer. And that's precisely what they're going to do. And they're going to do this. When inflation comes down, it's going to be okay. But he doesn't want to be another Arthur Burns. Arthur Burns was the Fed president of the early 70s, and we have to thank for, in part at least, for stagflation. And so he wants to be higher for longer. And that means he wants to have an excuse to pause. The excuse to pause is, on the one hand, no jobs reports that are out of whack on the upside, and inflation reports that are in line. And so when we spoke last, I said, well, my expectation is we're going to pause in May. That's because the year-over-year comparisons are going to look somewhat decent for the first quarter. And then in May, they're going to say, all right, we'll do, and we wait. Now, we had on last Friday, we had jobs report that we can talk about as to the details, but the short of it, it was much stronger than most people had expected. And so that says, oh my God, we can't do it. And by the end of that day, it took several hours, the market priced in that indeed we'll get another rate hike in June as well. So then we get another rate hike. And so now we're there. And so now we're going to wait again until the next data point comes in. If the next inflation report is benign, it's not going to change much. If the next jobs report, the GDP report is very bad, we might take that second rate hike off the table again. And so, and that's just how it's going to be. Now, the third point, though, that you raise, and where I strongly disagree with you, if what you have implied, you indicated about the delayed impact that the Fed action has. Well, you need a framework to assert that. And instead of saying, oh, he is fully aware of the delayed impact, no, what you got to listen for is the delayed impact is code for I'm just about done hiking rates. But it's not the same thing as having a strategy. So very different from Canada, where Tim Macklem, the head of the Bank of Canada, he said, all right, I've done my job for now, I'll wait now. Because indeed, I mean, it's absolutely correct, of course, that Fed policy acts with a long and variable rate. Indeed, if you looked at the Taylor rule, we would be having rate cuts right now. Now, we would have them from far, far higher levels. But what you expected to see is that with the current Fed that we have, okay, we'll hike rates, And then once he thinks we can wait, then he'll say, oh, suddenly it's going to act with a lag, right? But of course, it's acting with a lag already. And the only thing what he did last week is he alluded to that because he was on that bandwagon. All right, we'll do one more rate hike and then we'll pause. Although he had talked about rate hikes in plural throughout much of his speech, but the market didn't take it seriously. And it didn't take it seriously because of just everything else that's been saying. It's only now after jobs report that was through the roof, and we should talk about that a little bit, that the market adjusted to it and may have another rate hike. And so ultimately, right, we may not like what the Fed is doing, but the Fed has the bazooka, and that's why we listen to every word he says, because, hey, did he happen to pull the trigger? Ultimately, though, he said what he's going to do. So if we have strong economic numbers, and the reason he doesn't like strong economic numbers is because if you have 2 job openings for every job seeker, the theory is that that's inflationary. Not everybody agrees to that. And of course, the post-pandemic environment is a bit all over the place, but that gets him to want to be tighter. Some people, by the way, talk about that we're not going to have a recession at all. We can somehow sail through this. That doesn't jive with any of this because the tougher you are, and then you have that lag with which the Fed policy acts. It's in my view all but impossible to not get into recession territory.
All right, I want to talk about that with you too, real quick. So we're now talking just like less than an hour, I think, after Powell finished his discussion there at the Economic Club in Washington. The markets sort of leapt, and then they came back down to flat. Now it looks like they're coming back up again. So not entirely sure if they've made up their mind yet how they want to interpret it. But did he say anything else today that's germane to the discussion here?
I think it's relevant that he didn't say too much different because you mentioned 15 times disinflation. I think it was 11 or 12, but let's not argue about details here.
Double digits,
right?
Yeah.
Right. I mean, it's many, many times. And he used those words again. Now, the one when the market dipped after during Powell's speech, when he talked about these strong economic numbers might get them to be higher for longer. He didn't use exactly those words, but and so a lot of that is, of course, the market, the media just interpreting into what the market is doing, and maybe there are some bots that trade right away on any syllable that he says. Ultimately, what matters is what is he going to do? And by the way, the other thing to keep in mind is the folks voting at the Fed, and there are certain numbers are there each month, but then there are several people that rotate on a yearly basis. We have a far more dovish composition at the Fed this year versus last year. And so he's going to get more pushback against these rate hikes as they come along. Now, clearly, if you have more than 500,000 jobs created each month, they all can say, well, it's all right. We're not going to cause too much damage if we hike further. But I wouldn't be surprised if the economic data are going to be quite mixed, which means those dissenting voices are going to get louder. And that's going to make the messaging more difficult. By the way, one of the things that Powell had lamented is that the market doesn't take him seriously, right? Well, part of it is, and the market is somehow so much faster in absorbing information. Well, maybe the market is a little bit faster, but the key thing that has changed is forward guidance. So when the Fed finally decided to hike rates, they said everything they're going to do over the next 12 months or whatever it was. And guess what? If you do that, the market is going to price it in with some skepticism, but for the most part. And so the side effect of that is, and we talk about rates, is the so-called financial conditions, right? The whole point of hiking rates is to tighten financial conditions, to make it more difficult to have access to credit. That means to coerce the system to delever, to induce bankruptcies with weak players, with zombie companies, but not to cause financial mayhem. So you don't want the wheels to be falling off. And what had happened, because quote unquote everything had been priced in, is the market got used to it, and now financial conditions aren't as tight. And so the question is then, well, are they going to just be hiking a little bit more? The answer, I think, is they'll be somewhat, to use that word, data dependent, meaning if you have a upside surprise jobs report, maybe they'll consider hiking one more time. Although, of course, right? The economists at the Fed are the first to tell you one report is not going to sway them. And so all of that, I mean, if you're not confused listening to all this, then you haven't paid attention. It's because the Fed doesn't have the strategy, and that's why we're reading these tea leaves. At the same time, at the Economic Club in New York today, there was no Q&A from the audience. It was all a bunch of softball questions, and he was asked about his playing of the guitar and whatnot. I mean, it's kind of cute, but it was all about him explaining what he does at the Fed, which allowed him to say just about everything. Whereas last week, the journalists that asked the questions to Powell, they trapped him. And one of the things I have argued is, why the hell do we have these press conferences?
I saw
a Fed official. I was off on a rant, and the thing is, you get yourself into a situation where you have to talk. And why do you do that? You, as the one controlling the bazooka at the Fed, you talk when you have something to say. And so why do you have to speak after every Fed meeting? Why do you have to? There was nothing to be gained at the last press conference, and a lot to be lost. And sure enough, he fumbled it, and the market thought that he is not serious, right? And he would have been far better off not talking.
And just to flag, your criticism extends beyond just the Fed, right? I know you've had similar comments about Lagarde and the ECB. You just feel like these things do more damage than they help, right?
Absolutely. I mean, it of course doesn't help when you have a politician leading a central bank. I mean, that only exacerbates it. Now, what you need is a sound framework, and then you need to communicate how you are implementing that framework. And all the other fluff and stuff they should forget about.
Yeah, and what you're reminding me too is these press conferences they're working for the Fed the same way it works with you and your spouse when you finish the argument and then you come back and you say, well, just one more thing, right? Nothing ever comes good of that.
The one more thing is, yes, honey.
Exactly. All right. Well, look, a couple just quick questions to help folks understand things a little bit better, including myself. So you mentioned that the Fed board is comprised of more dovish people this time around, the voting board. When it comes to a Fed vote, is it a majority rules? Is it a dictatorship? I mean, if everybody else is differing from Powell, the chair, who wins out?
Well, theoretically, he could lose, theoretically. But in every country, there's a different culture, and that culture is adhered to. You mentioned the ECB, right? They bicker behind closed doors, but then they're all supposed to represent the same view. That kind of has broken down over recent years. The UK has a culture where people disagree. So you have a dovish dissent, a hawkish dissent, and the gloves come off, and it's fun, right? In the US, it's like they're the Fed governors, they're political appointees, and they rarely dissent. And in part because they don't have their own staff. And so if they dissent, the Fed chair can say, well, you don't get anybody to work with you. Whereas the regional Fed presidents, they're independent. They have their own funding, they have their own environment. They can pretty much do what they want. And so then it really depends on the personality, on what they are and who they are. And in history, there have been a few pronounced people. Bullard of late has been more influential. As you know, we work with the former St. Louis Fed chair, Bill Poole. He used to be one of the more influential speakers. And that's the folks that have more influence are the ones who speak up when they have something to say, and don't just seek the microphone for the sake of it, but then also stand up for their opinion. Now, when you dissent, you can have, of course, the choice, right? You can disagree every time, but a lot of these folks are also team players. So they would voice the dissent once, either strongly internally or by voting against something. But then some of them would then not dissent in the following meetings, because what's the point of that, right? One of the things that's important when you conduct monetary policy is the credibility on top. And so if you know you don't have the majority of the dissent, you might as well shut up. So it could be that there's some dissent brewing internally, but they don't put it on the record because for them, it's a very big deal to dissent. So it really depends on the character of the person. And the short of that is when you see a dissent at the Fed, it's typically a big deal.
Okay. Just to get into the weeds of the mechanics just for one sec. So if there's a vote, say like, okay, are we all in favor of raising, 25 basis points this month? Does it pass or fail by majority, or does the chair have a
Yes,
super
no,
majority?
it does pass
Okay.
by majority, but it's rare. And I just right now we got the voting folks are Williams, Harker, Kashkari, Logan, and the fellow from Chicago who's new, Austin Goolsbee, and he might be somebody who might say no, we can lower rates already, or he could be dissent on the dovish side based on his speeches. He is not well known yet because he hasn't voted much, but in his public comments, so he's a newbie at the Fed, an unknown quantity.
All right, Axel. So another thing that I'm hoping you can clarify for me is, I heard you say that financial conditions have been loosening, and I've certainly seen financial conditions indices. There's one put out by Bloomberg, there's one put out by Goldman Sachs, I believe, a few other places, that show that financial conditions are looser today than when the Fed started their rate hiking campaign back early last year. But I heard Powell say that they were getting tighter in his presser last week, and in my real quick read up of what he just said today, it seemed like he reiterated that. So what's he talking about when he says they're tightening?
Well, partially because we are comparing apples and oranges. Most of these financial conditions indices are crap, at least when it comes to Fed purposes. You mentioned the Bloomberg index. You might as well use the VIX index. They have references of the volatility of the stock market. The Fed is not concerned about the stock market, despite what people talking about Fed put and whatever it may be. What they're concerned about is the health of the banks, the banking system. That means they're concerned about credit conditions. They're concerned about credit spreads. So the junk bond, what premium does it trade over treasuries? Even those numbers are distorted because a lot of the quote unquote junk is on the energy side, and that sector is doing just fine. And so there's a Chicago Financial Conditions Index that I look at that's a little bit better. But ultimately, it's the health of the credit markets. And on relative terms, it's a little bit tighter. It went significantly tighter, then eased again a little bit. Nothing in alarming territory. And that's, of course, part of the thing. You don't want, if you're running out of these central banks, you don't want it to be so tight that the wheels are falling off, right? And one of the reasons why the market is always pricing in some rate cuts down the road is because there's always this unknown. There's always this possibility of a shock hitting the system. And just if you add up the probabilities, the further out you go, the higher the likelihood that something like that is going to whack you. But you don't want to induce that. And so when we talked 9 months ago or so, I think we just had the gilts blow up in the UK. And so the question is, are we going to have some spreading of that to US markets? Well, we didn't. And I think I mentioned to you on last time we spoke, right now, it looks like, no assurance of that we'll get an environment similar to the early 2000s, in the sense that, yes, we have a significant correction in the stock market. Yes, we'll have a deceleration economy, but we're not going to get a blow up. And if that's the case, then the Fed can do what they say they're going to do. They're going to be, quote unquote, higher for longer. Obviously, always a caveat, if something really bad happens, they'll go back to zero.
Right, they got to come in and rescue it.
Yeah. They'll do that, but that's kind of the more likely scenario these days. The thing that's got lost in all of this, and let me just pull back to that, right? We started all this because inflation was too high, because the Fed was asleep at the wheel, right? What the Fed hasn't done, they haven't done the introspection that's needed. I mean, even Powell even said that, we're not going to look at how we conduct monetary policy for a few more years. Everything is dandy. Well, the jobs report last week again proved that the models think, right? They're just bad. Paul Volcker used to say, you cannot possibly predict inflation and manage that to the second decimal point, or even to the first decimal point. That's just all a bunch of over-optimization that just causes far more problems than it solves. And so what we need to do is have more common sense. And what I've argued about is we should get rid of the discretionary power at the Fed altogether. Remember, right? The Great Depression is due to the Fed. the great inflation during the 1970s is due to the Fed. The issues we've had now with inflation are due to the Fed. Obviously, the political side of things makes things worse. That's why we then get stagflationary sort of environments. But the way to fix that is to get rid of, you asked about the dynamics, how things work on the FOMC. Well, by having, I think there are 18 people in total, obviously not all of them are voting, but by definition, they're going to be too slow to react. And so they were too slow to react on the way up when inflation came. And then with the lack of framework they have now, how on earth can they react on the way down? And so they will induce a more severe recession than otherwise necessary. So they don't have a framework. They have a process that doesn't work. The models suck. And so somebody has got to admit that and go back to the drawing board. How this entire system should work. And one way it could work is if you simply make interest rates based on inflation and then maybe unemployment. End of story, right? Because then people would predict that, and yes, interest rates might move more, but you would know exactly what's going to happen. The market could price that in, and we would avoid the sort of things that we get every 30 years or so of a really, really bad outlier that's causing not just economic hardship, but there's political fallout. People get disillusioned when you have a crisis and all the bailouts, and people lose faith in capitalism. So there's a lot of bad stuff that happens when you have this discretionary power at the Fed.
All right. I wasn't necessarily planning to tread fully into this territory, but let's do it briefly. Okay, so it sounds like, Axel, if I make you emperor, you would have market set interest rates rather than a centralized organization setting them. I'm curious, would you have a central bank at all?
Well, you need to, there are different ways of going about it, right? And there's always talk about, oh, let's get rid of this, let's go back to the gold standard and so forth, right? The question is what framework you're in. You can only have a gold standard if you have a fiscally sustainable household, right? Because what happens in practice, we saw that the Eurozone most recently again, right? When the fiscal side is not in order, the central bank will always cave. Because ultimately the loyalty is to the financial system, the loyalty is to the government. And so you need to design the entire system to be fiscally sustainable. You need to have an institutional circuit breaker to have, because if you don't have that, all that other talk is fictional, right? I mean, it's just, it's hypothetical, because it doesn't really matter, right? Beyond that, you need to, I mean, you should have the money supply grow steadily, because that's ultimately what drives inflation, to have that just grow a tad, and then not worry about some outliers. Right, disinflationary periods, I don't want to use the word deflationary, are not a problem unless they're associated with a credit bust. Again, those are not really my words, they're Volcker's words, right? Having inflation be negative is not in itself bad. And it's only bad if you have a credit implosion that's associated with it. And so there's a lot of these things that happen. Now, again, though, it doesn't really matter what I think, right? What matters is that every time there's a crisis, we take all the crisis tools from the past and then double down and do things further. And that, I think, is a very, very slippery slope that we have been on and unfortunately continue to be on.
Yeah, I mean, the way that I see it is by intervening, the central banks oftentimes, create a problem that is worse than the cure that they're trying to deliver in that one moment. But kind of like culturally, we seem to have gotten into this world where we just don't want to deal with any negative cycles. And the problem is that markets and economies naturally operate in a cycle, right? And there's benefits to the clearing out of the down cycles, right? There's benefits to inflation, where they eventually prices get so high, they put the brakes on things and things cool back down to a happier medium. But we have decided, it seems, to just intervene at any point in time when the not fun part of the cycle wants to express itself. And then by pushing it out, delaying it, we end up just increasing the magnitude of it happening when it inevitably must at some point. And then we get stuck in this intervention, rescue, creating additional bubbles that then burst and require bigger interventions and rescues cycle here. At least that's one interpretation of it. Do you share that?
Well, it's called human nature. I mean, we don't want to take the painful medicine, especially when times are good. And the one thing, I mean, one reason why I think your service is valuable, because it helps educate people. I think folks that believe in non-interventionists, that believe in free markets, have done a very poor job defending capitalism. Right? People, take any youngsters grown up during the financial crisis and since. Can you blame them to turn their back on capitalism with all the crap that's been going on? We need to explain what capitalism is, what free markets are, what the benefits are of what has happened since the Industrial Revolution, what's the benefit of having abundant access to energy so that we can allow democracy or republic to thrive. Those sort of connections, right? Whereas instead, everybody's used to just complaining of what's not working for them. And so if others then don't speak up about the sort of principles that work, and it's Tom Sowell wrote a book, I think it was in the 70s already, talked about the different visions that people have, and that some people are interested in outcomes and some people are interested in principles. And the folks that are interested in outcomes have the upper hand. Whereas the folks that are interested in principles, that says there's always going to be somebody abusing the system, right? But if you try to get rid of every tax loophole, then you're going to make the system not work anymore, right? You got to accept that perfection is not the answer. The answer is a framework that works for most people. And then, yes, you can see whether you need to help and how you want to help, and society can decide how to help people that fall through the cracks and whatnot. But you cannot do what, for example, Dodd-Frank is doing, to take it back to finance here a little bit, try to take risk out of the system. Well, if you take risk out of the system, then suddenly, guess what? Economic growth is stifled, and there is not going to be somebody there providing a market when push comes to shove. Right. I mean, remember, take the futures market in physical commodities. The commercial hedger needs a speculator, and through that, the system is better off because the producer can hedge the cost and so forth. But you need the guy who is nuts enough to take the risk.
Right.
That's a feature of the market, right? And so, but if you condemn those folks, things don't work. And so it's no matter where you look, you've got to look at the unintended consequences. And then once in a while, yes, you should look and do a reality check. And the reality check on the Fed, I think the verdict is pretty clear that the way that the Fed is working is not working.
Okay, and look, this would be. I'm sure there are people watching who would love for this to be the full focus of this discussion. It's a very important discussion to have, and Axel will have you back on to keep taking whacks at this. But let's shorten our viewpoint here just to the next couple of quarters for a second. It seems to me that the concern that you have, based upon the Fed's human nature here, is that it is creating the potential for a much deeper recession than would otherwise be necessary here, right? Like you said, if we were looking at the Taylor rule and whatnot, we'd already be cutting interest rates at this point, but we're not. In fact, we're continuing to hike them. And my guess is, and correct me if this is wrong, but looking at all the macro data and everything that you see coming, that you see the potential for a hard landing coming up, and potentially one that's a lot harder than it otherwise would need to be.
So just to be clear, cut from much higher levels, just to make clear.
Okay. Yeah. Had we been governing by the Taylor rule, we would have hiked rates a lot earlier. Yeah, exactly.
Exactly. Yes, because I mean that Powell says as much, right? I mean we need to have a period of below average growth, and growth can also be negative in that sense, right? He wants fewer job openings, and he will get that. What he'll also get is more than he's bargaining for, because Fed policy acts with a lag, right? And so it's I mean, the simple answer is don't fight the Fed. You can hide under your pillow, or you can just say, yeah, this is what the Fed says they're going to do, and they will do it. Now, the way they go about it, we may not like. We may not like their reaction function. We might like this or that. But the short of it is, yep, they'll hike rates. They'll be higher for longer. At the end of the day, we won't have solved the problems, but we'll have a mess at our hands.
So let me ask you this. How worried are you, like, about this particular recession possibility? Is it something that I assume you got to be planning for it already with how you manage your funds, but I mean, how concerned are you?
Well, I mean, for full disclosure, most of your audience knows me presumably, but we manage a good $1 billion in gold and gold mining. And so we do have a little bit of an institutional bias here. But one of the things that, and this is not investment advice I'm giving here, but one of the things last year that was pronounced is that nothing worked. Gold did better than some things, but still nothing worked. This year, I have a hunch that diversification will work much better than last year. And so that's good news. And when I talk about diversification, I think about broad diversification. If you talk about our space, the gold space and the gold mining space, that tends to do better in a deeper recession. Because if you have a shallow recession, then risk assets, equities, discount that and go off to the races. If you have a deeper recession, the negative earnings will potentially cripple the stock prices. And at the slightest sense of a pivot or of a less hawkish stand, and I happen to think that happened last November when we moved from the 50 basis points to the 25 basis point rate hike. Ever since then, gold has been doing quite well. Obviously, on a day when the jobs reports are huge, it gets dinged on its head a little bit. But I think we are in that scenario that's already more favorable for that. Beyond that, I think it was Gundlach who said that he supports a 40-60 portfolio or something like that, where you switch the equity and bond allocation. Mm-hmm. He obviously also is touting his own hand. He's a bond manager, but I do agree that bonds may do better this year in that sort of environment, because when the Fed over tightens, you might have the long end of the yield curve rally. Now, obviously, different views on what may happen with inflationary influence and all that. But I do think a broader diversification that includes commodities, notably also precious metals, might be doing better. Now, note, all this talk is different from, you didn't have this channel in 2007, 2008, but we talked at the time. And in early 2008, I sold all my equity holdings. And I'm not there. I do think that the S&P 500 that outperformed for many years is going to be the laggard on the equity side in the global context. Mm-hmm. Because I do think, I mean, anything from small cap value, that's the sort of thing that performed well post 2000 to international equities, as some of the world is trying to reflate. Remember, China's trying to reflate, so that might outperform on a relative basis. And so it's going to be a more differentiated picture. But at the same time, when I talk about my personal assets, we sold some real estate a while ago and haven't deployed that money because I don't want to fight the Fed. But some equities, and I've always had a very low equity position compared to others, given our institutional, so to speak, gold exposure. I didn't liquidate those assets, right? So I'd rather write that through, because I do think on an inflationary basis, those equities might do okay. That said, if you go to the 1970s, there is, of course, the sign that equities in a stagflationary environment on a inflation-adjusted basis can underperform quite significantly because inflation is going to eat away the gains. And we're not out of the woods on stagflation. And key reason there is because the Fed doesn't have a strategy, and then what the political side does often exacerbates the problem, right? We're talking here ahead of the State of the Union address. Presumably there's going to be a call to increase various taxes and so forth. We'll see if those are hurting investment or otherwise are curveballs that are politically convenient but economically not sound. stagflation is well back on the table. Some people say we are as we were in the late 60s. Stagflation started then and then lasted for way over a decade. And so I would not be surprised if that persists.
Okay, great answer. It sounds like you are concerned, but not the way you were in 08, where you just sort of liquidated pretty much all exposure to the markets, or at least the equities.
That's why I'm talking to you from the second floor. In 08, I did not go above the first floor because I didn't want to jump out of the window.
Too afraid you might jump, yeah. All right, I'm going to ask my question again with a little bit of a different focus. So, we have a lot of regular people watching this video, right? And there are other things that happen in a recession besides just stock prices go down, right? Notably, people's home prices may crater, people might lose their jobs, that type of stuff. So in terms of how the recession may feel to the average person, what sort of Richter scale level would you give what you think may be happening this year? And where I'm trying to go with this is I'm not trying to peg a number, but just kind of like is this something the average person really should be preparing for in advance?
Well, let me give you, first of all, it all depends on whether you keep your job or not, right? Because it's a recession if your neighbor loses your job, and a depression if you lose your own job. And I think you just had a survey on Wealthion on whether, on how much buffer people have. And I don't have the results, but from what I hear that people have a bigger buffer than the average population.
We have a more well-heeled audience, thinks ahead exactly. Like this.
But the point here is, and the folks listening to your channels, right? They think about these issues, and anybody who's been through the pandemic, which is everybody, kind of realizes that your income could be gone in an instant, right? Even if it didn't hit them, they saw plenty of people who, through no fault of their own, lost their livelihood pretty much. Right? Then they got bailouts, and they maybe got more bailouts than economically was sound, but shit happens, right? It can happen. And so now we have this most forecast recession ever. And so, yes, any reasonable person is going to say, well, yeah, let's look at my expenses, right? And let's keep in mind, right? One's livelihood is both income and expenses. And on the income side, it's not just what you put into the stock market or the bond market or commodities or real estate. It's also how good is your job training, right? How physically healthy you are, so that because you're an income generating machine. And so in a potentially protracted recession, you want to invest in all of those. And the most important thing is, of course, that your income is not higher than your expenses, right? It's in 2009, I wrote a book about that, 250 pages, but it's really it's a tweet, right? Don't spend more than you make, right? That's the summary of that. You don't need to read the full book. And so when times are uncertain, people become more conservative, right? The first thing people get rid of is leverage. And then beyond that, right, different people make sometimes more and sometimes less reasonable decisions. I can't give specific investment advice, but people want to check that they are okay if things don't work out as great as they think it should or should not, right? And so that's ultimately you gotta be able to afford the risk of your action. Like you got to be able to afford the risk of being invested in the stock market. You got to be, and one of the things we've discussed is, right, in spring of 2009, right, there was the bottom of the stock market, and some pundits said, oh, you should double down. Although that was technically correct, I still said and still believe that that was reckless, because many folks didn't lighten up on the way up. And so they lost more they could afford to do. And telling folks like that to double down on risky investments is reckless, because that's how you lose sleep. That's how the moment there's a little hiccup in the market, you're going to sell out at the wrong spot. What you need is you need a strategy. The strategy doesn't have to be great, but there needs to be a plan. There needs to be a plan so that you can cross-check versus your plan. And you've got to be able to sleep at night. And that's not just the gold bar under your pillow. You got to be able to sleep at night with the sort of investments you have. You got to be comfortable with the risk profile.
All right, great advice. So in addition to railing against the Fed for not having a plan and a framework, it's equally important for us as individuals to have a plan and a framework. And if we don't have one, it's the classic, to fail to plan is to plan to fail, right? All right, well, look, we got to begin to wrap this up, but I do, since we're talking about, potentially losing income, I do want to talk about the jobs report real briefly. You mentioned it earlier on in the conversation here. I'll let you say anything about it that you think is material that we haven't already touched upon, but I do want to start with the question of how much faith do you put in the jobs data? It just seems like so much of an outlier compared to all the other macro data I look at.
Well, it is what it is, right? We know how it's.
Well, is it? I mean, that's kind of my question. Like, is it what it is? Are these really true numbers?
Well, the one big caveat that comes this time of the year every year, and people forget about it in the other 11 months. Every January jobs report, which is the one released in early February, has a new seasonal adjustment, and all the adjustments from the previous years are rejigged to fit the seasonal adjustment formula, and that in itself generated over 200,000 jobs in the numbers. Now, if you take those 200,000 jobs out, you still had a strong jobs report.
Still a big, yeah.
But you have this time of the year, you almost always have an outlier because of the methodology that's used there. And so you've got to be a real data nerd to dig into that and understand that. And even most economists that follow that stuff don't fully grasp what's happening here. And the pandemic has thrown a huge curveball into all these metrics. And so you have now in the seasonal adjustments, you have, if I'm not mistaken, it's a 5-year moving average that they take. And so you've taken one more normal year out, you have one more pandemic, this abnormality in there. And so all these seasonal adjustment factors that factor into these reports. Now, all that said, if you take the non-seasonally adjusted numbers and then there's a separate survey, all these numbers were a bit all over the place, right?
I'm going to interrupt you. I'm going to let you keep going, but because you're a pilot, okay, this is the spirit of my question. The importance of your instrumentation being accurate is super important, right? So using the jobs report as a navigation tool, how much faith do you put in it as a pilot?
Well, you gotta be.
Are you willing to fly your plane by it?
When you're a pilot, you gotta be able to always think: is your instrument fail? Has your instrument failed? And so, what else are you going to do? And then one of the most important things is, and the bigger an aircraft you fly, the more important it is. Remember the laws of physics. There's a certain inertia, right? You got to keep calm, right? If you fly what I call a flying lawnmower, then you can kind of jump all over the place. But the bigger the bird is that you're flying, the more calm you got to be. And when you have a surprise, you just got to stay calm and think about what it really means. So not to overreact. Economists would say, right, you got to see several of these data points. So I certainly don't think that the economy has changed with this report. And maybe we'll never know what the hell was happening in that report. It does appear that you do have the layoffs in some industries. It does appear that the layoffs are spreading. It does appear they're spreading at an accelerating pace. But it's also the case that people are joining the workforce again. Quite a few joined the workforce. And so they're finally coming back post-pandemic. A lot of these people going into service areas jobs. And so that's part of that normalization process. It's also the case that in various industries are people reluctant to let people go because it's been so difficult to hire them in the first place. Sure. So you have these cross currents. The jobs report that we hear about that makes the main headlines is based on a survey. So there's the other thing, right? How are people answering when you ask them, are you looking for a job and so forth, right? Just you tell me yourself, right? Are you willing to answer these surveys? I once got a call for one of these surveys. And I was in the car, and the person doing the survey wouldn't want to talk to me because that's one of the policies. And it says, well, I'll call you back when you're not in the car. And it says, no, the only time I have to chat with you is when I'm in the car. So sorry, you got to scratch me off your list then. right? And so there can be quirks like that in the sort of in any of these surveys.
All right. Well, is there anything else about the fact that jobs still seem to be very robust here that is going to be influential in any way to how you think things unfold from here, whether it's Fed decision making or?
Well, we know that Powell is concerned about too many job openings for each job seeker. And that's traditional economic theory. I tend to agree with that, right? If you have 2 job openings for every job seeker, that means you have a lot of bargaining power as a job seeker. And that is potentially inflationary, right? That's why a central bank doesn't like it. Now, whether it translates to inflation or not, of course, remains to be seen. To me, it's a question of risk assessment. But Fed wants the economy to slow down, and which means he's going to slam the brakes harder, right? I mean, that's the short of it. Whether it doesn't really matter, I don't think, whether jobs report was good or bad. It matters what the Fed is going to do about it, right? And so this nudges the Fed to do 2 more rate hikes, and now we'll need to see the next data point. In my view, we're going to have some bad ones likely, and they'll come back. But at the same time, I'm also in the camp that I don't think inflation is conquered. I just happen to think the next several months they're going to be fine, right? So I actually think if they do 2 more rate hikes, the Fed in the medium term is going to be better off. They will use a framework that I don't think is a good one, but I mean, who the hell cares when you get your mortgage whether Mr. Axel Merk thought it was a good framework or not, right?
All right, look, well, I promised I would try to limit this within an hour, Axel, so I'm going to have to begin to land the plane here, as I like to say a lot, which is very appropriate in your case, being a pilot. 2 last questions. First of which is, you mentioned stagflation a little bit earlier, but last time you were on, you were just launching a stagflation ETF. Now that we're several months further down the road here, what is sort of your stagflationary outlook? You know, you still seeing all the same reasons in play for why you created the ETF in the first place?
Yes. So since you're giving me a softball here, STGF is the symbol. We launched it in May. You don't launch an ETF if you think you have a 3-month stagflationary period. You launch an ETF if you think it has several years of good life in it. And stagflation is a result of a supply shock and a policy mistake, where policymakers mess things up, be that with price controls, be that with stimulus checks. California just sent out another batch of checks, for example. Be that
so not so to you or me.
How,
but...
I got one.
Did you? Oh God, lucky you.
I got one because according to the state of California, there was a trading loss that I accounted for in one of the years that you qualify for, and that for the state of California got my income down, so I got a check. It's a messed up system, right? It's something like 90% of the state gets a check. Like it's not like just the bottom 5%. It's ridiculous. And the IRS is issuing a ruling that that Californians should delay filing a tax return because they don't know yet whether that's considered income for federal purposes that we got these checks. And so it should be, but maybe they find a loophole that it isn't. It's stupid. Anyway, the stagflationary period can well last several years. And what a stagflation ETF is, it has a big weighting in tips. And then we invest in oil, real estate, and gold as well. Some people say, oh my God, why do you have this big weighting in tips? And by the way, tips didn't do great last year. With tips, you lock in real rates on a forward-looking basis. And so if you think we've reached peak hawkishness, then tips is a place that might be worthwhile being. But the whole point of that ETF is not that you make returns to the roof, but yet you have a diversifier to your typical bond allocation. And that's why there's such a high allocation to that. And there's also a REIT allocation. And so it's something that I think will last several years. I think it's a diversifier that people do want to look at. And yes, so that's why we launched it.
All right, great. And when we edit this, Axel, we'll put up the ticker there on the screen so people know where to go to learn more. And speaking about learning more, for folks that want to follow you and learn more about you and your work after having watched this interview, where should they go?
The first stop is probably Twitter at Axel Merk, because that's where you get my live views. On my Twitter profile, there's also a Linktree link that provides a link to many of the other things we do. Notably, you can sign up for our newsletter there. You can go to merkinvestments.com, where you'll learn more about our company. From there, you can go to our investment products as well. I can't discuss them here too much because of regulatory and compliance reasons, but Twitter is a good space to start, and then merkinvestments.com as well.
Awesome. Okay, we'll put those URLs up on the screen too. All right, well, look, and wrapping things up here, just want to make folks aware of two resources. One, the Wealthion Spring Conference is coming up. That, again, is going to be on March 18th, and that's a Saturday. I got to remember to remind people, if you can't actually attend the live event, everybody who registers is going to get replay videos of all the presentations, all the Q&A, just like we've done for all our previous conferences in the past. So don't worry if you can't actually watch live. You'll get the replays of everything that you can watch to your heart's content afterwards. But real quick, the faculty for that continues to just blow out and be amazing. We've got Lacey Hunt delivering the keynote, Mark Faber, Michael Pinto, Danielle DiMartino Booth, Stephanie Pomboy, Rick Rule, Doomberg talking about energy, Craig Wishner talking about farmland investing, Mike Maloney talking about precious metals, Lucky Lopez talking about the auto market. There's a few other people I think I've forgotten to mention, and there's a few others that we're still locking in, but as you can tell, it's a great collection of true domain experts there. To find out more about the conference and register and lock in the early bird discount price, just go to wealthion.com/conference. And Axel has done a great job in this discussion of flagging the challenges that human nature driving monetary policy, the challenges that creates in the markets, this distortion between what the markets are doing today versus maybe the type of future that might be in front of us with this harder landing. What you want to make sure you do in uncertain environments like this is work with a financial advisor who understands all these macro risks and can help you put together a plan, right? The framework that Axel was talking about for you, and then actually help you execute against it. If you've got a good one who already does that for you, fantastic, stick with them. But if you don't, or you'd like a second opinion from one who does, considering scheduling a free consultation with the financial advisors that are endorsed by Wealthion. Doesn't cost you anything, no commitment to work with them. It's just a public service they offer. They'll sit down with you, they'll do a free portfolio review, they'll tell you what they think you should do. You can go off and do it yourself with your existing advisor, or you can talk more with those guys if you like. To set up one of those consultations, just go to wealthion.com, fill out the short form there, only takes you a couple of seconds. Axel, I think I'm just getting in under the hour here. Thanks so much for giving us so much of your time. It's always great to have you on the channel, my friend. I really appreciate you coming on short notice in reaction to Powell's recent appearances. Love to have you back on this channel anytime you feel you've got an update for our audience. But just want to thank you so much again.
Great to have been with you. Yeah, take care.
All right. Everybody else, thanks so much for watching.